Welcome to this explainer. Let's just dive right into the groundwork being laid for what is shaping up to be the absolute largest initial public offering in human history. Elon Musk is reportedly preparing to take SpaceX public, and the target valuation is a jaw-dropping $1.75 trillion. Now, to really grasp the magnitude of an event like this, we've got to look way beyond just the headlines. An IPO of this scale isn't just some corporate milestone. It fundamentally alters broader market dynamics and vacuums up vast amounts of global capital. So we're going to unpack exactly what is hiding behind that massive number, and more importantly, how it directly impacts your money.
To put that completely unprecedented number into perspective, a $1.75 trillion valuation makes this single entity worth more than every American defense contractor combined. Beyond that, that scale makes it worth more than the market caps of Coca-Cola, McDonald's, Disney, Nike, and Starbucks, literally all of them combined. Think about the cultural and financial weight of those legacy brands, right? You have generations of global infrastructure, billions of daily customers, and decades of steady, reliable earnings. And all of that is dwarfed by the valuation of this one overarching aerospace company. It is an absolutely staggering figure that demands a flawless underlying business to justify it.
So that brings us to a really crucial point, and we have to ask a very logical question. Who on earth buys a company that is actually losing nearly $5 billion a year? It's a huge paradox. We have a record-breaking valuation sitting right alongside massive cash burn. Despite that astronomical target price, the consolidated SpaceX entity lost billions last year. So who exactly is stepping up to buy this at the largest valuation in history?
Well, the answer is you. And I don't necessarily mean you're going to log into your brokerage account and actively hit the buy button. Within a few weeks of this potential listing, the underlying mechanics of your retirement account, like your 401k, will automatically make you one of the biggest buyers of this stock, whether you actively choose to or not. It's just a reality of modern investing where index funds do the heavy lifting for us, but it also means our capital gets deployed automatically.
Section 1. The Three Faces of SpaceX.
A few months ago, SpaceX acquired the AI lab xAI in an all-stock deal valuing it at $250 billion. But market observers are quick to note that xAI's valuation is pretty high compared to its revenue. When you compare it to main competitors, OpenAI generates around $24 billion in revenue, and Anthropic generates over $30 billion. Meanwhile, xAI has an estimated $1 billion. To understand the sheer cost here, you have to remember that training advanced AI models requires massive, insanely expensive computing power. Think huge warehouses full of top-tier NVIDIA chips running 24/7. That explains why xAI burns roughly $1 billion a month. Plus, the lab recently saw all 11 of its heavyweight co-founders depart, which naturally prompted a massive internal rebuild from the ground up.
Because of this incredible cash burn, market analysts have actually started jokingly referring to this AI division as the reverse Jerome Powell. Because instead of printing money, it aggressively burns through whatever cash the rest of the business manages to generate. It functions kind of like a heavy financial anchor, dragging down the wider company's balance sheet. When a division is this capital-intensive, it requires the other arms of the business to work overtime just to keep the entire consolidated entity afloat.
Now, when you break down the estimated 2025 revenue, the narrative shifts away from what we usually see in the news. You might naturally think rockets and space exploration are the main event, but the launch business actually only makes up about a quarter of the revenue. xAI and other miscellaneous ventures sit at roughly 14%. The true financial engine here, the massive segment taking up 61% of the pie, is Starlink.
Starlink is literally an absolute cash cow. It's the fastest scaling telecom company in history. They've got over 10,000 satellites beaming internet down to over 10 million active subscribers across 150 countries, and they are securing massive contracts with everyone from commercial airlines to the Pentagon. But the most crucial detail here is the margin expansion. We're talking about growing from 41% to 63% profit margins in just 2 years. In the telecom industry, jumping from 41 to 63% is exceptionally rare and incredibly lucrative. It happens because once the heavy infrastructure, the satellites, are up in orbit, adding new subscribers costs next to nothing, which lets those profits scale exponentially.
So let's just do the math on the consolidated company. The core businesses, Starlink and the rockets, are highly successful, bringing in a combined $8 billion in profit. But when xAI gets factored into the consolidated balance sheet, that massive cash burn offsets the profits. The immense artificial intelligence costs actually pulled the overall entity down to a nearly $5 billion net loss on roughly $18.5 billion in revenue. It's this wild dynamic where a highly profitable aerospace and telecom operation is fully funding an incredibly expensive AI startup. And that brings us to a major question regarding market mechanics.
Section 2. Changing the NASDAQ rules.
How does a company operating at a massive consolidated loss guarantee billions of dollars in investment capital at a record-breaking $1.75 trillion valuation? Well, it all comes down to the financial system fundamentally shifting its requirements. On May 1st, NASDAQ quietly introduced a new fast entry rule. Under the old rules, a newly listed company had to wait 3 months before being added to the prestigious NASDAQ 100 index. This gave the market 3 months for what's called price discovery, which is just the time it takes for buyers and sellers to naturally figure out what a stock is actually worth once the initial IPO hype dies down. The new rule compresses that wait down to just 15 trading days. That is 3 months of crucial price discovery condensed into just 3 weeks, which significantly alters traditional market safety buffers.
Furthermore, historically, to join the NASDAQ 100, a company needed a minimum free float of 10%, meaning at least 10% of its total shares had to be available for the public to trade. A low float usually means high volatility, because a smaller pool of available shares can cause the price to swing wildly on normal trading volume. That is exactly why the 10% rule existed in the first place, to protect investors. Now, SpaceX is reportedly only targeting a public float of 4 to 5%, which used to be an automatic disqualification. But under the new rules, that historical minimum requirement has simply been eliminated.
And this builds into something even more complex, and quite frankly fascinating, a hidden multiplier. Buried right in the technical language of these new rules is a mandate that if a company has a free float under 20%, the index weight treats that float as 3 times larger than it actually is. So if we do the math, SpaceX's tiny 4 or 5% float is legally treated by exchange-traded funds as if it were a 12 to 15% float. This drastically inflates how heavily the stock is weighted within these massive passive indexes.
Financial analysts point out that putting all these specific rule changes together basically engineers a form of manufactured demand. They skipped standard price discovery, they bypassed historical free float minimums, and they applied a 3x artificial multiplier. What this means in practice is that the $600 billion sitting in passive index funds that track the NASDAQ 100 will be legally forced to automatically buy billions of dollars of this stock, simply because the underlying index rules tell them they have to.
Section 3. You are exit liquidity.
So we need to identify exactly whose money is being used to fund this forced index demand. Standard public offerings usually allocate roughly 5 to 10% of their shares to everyday retail investors. Usually, institutional investors get the lion's share to provide long-term stability to the stock's price. But SpaceX is taking a radically different approach here. They are targeting a massive 30% allocation specifically for retail buyers. That is an enormous, unprecedented amount of supply being directed right at the everyday public, far beyond standard market practices. Now, why are they doing this? Well, SpaceX CFO Brett Johnson explicitly pitched this massive allocation to a room full of bankers as a way to recognize the long-term loyalty of retail buyers towards Elon Musk. The official corporate narrative is that they want to reward everyday retail investors who have been incredibly supportive for a long time, giving them a much larger piece of the pie right out of the gate. However, market critics and portfolio managers like George Noble view these mechanics a bit differently. He put it bluntly, stating, "Your 401k is the exit liquidity." The argument from some observers is that everyday retirement accounts aren't necessarily being rewarded. Instead, they're simply being utilized as a vast sponge to absorb shares at a peak valuation. This mechanism allows early insiders and venture capitalists to cash out their initial investments using that massive influx of automatic 401k capital. Let's just slowly walk through this passive investing pipeline to see exactly how this causality plays out. Step 1. Early insiders hold shares on a very low-cost basis. Step 2. The newly updated NASDAQ rules force the company into major indexes almost immediately. Step 3. The mechanics of passive index funds are mathematically forced to automatically purchase the stock to track that newly updated index, which directly leads us to Step 4, where everyday retail 401k accounts, which are heavily invested in these exact index funds, end up absorbing those shares at the valuation peak. Each step just triggers the next. As we wrap up this explainer, I want to leave you with this final thought to chew on. Passive investing was originally sold to us as the ultimate set-it-and-forget-it triumph of common sense, right? It featured low fees and easy diversification. But what happens when the rules of your index fund are quietly rewritten to make you the guaranteed buyer for a heavily valued company operating at a consolidated loss?
It really is a double-edged sword, and it serves as a crucial reminder to always seek to understand exactly what the modern financial system is forcing your retirement account to buy.